We're going to talk about tax segregation today. I'm going to talk to you guys about taxes, benefits of real estate and taxes. So Wikipedia, okay? United States, what is tax segregation? According to Wikipedia, under United States tax laws and accounting rules, cost segregation is the process of identifying personal property assets that are grouped with real property and real property assets, and separating them out of personal assets for tax reporting purposes. Okay, so tax segregation is basically, in a nutshell, when you take a real estate asset, then you take all the personal property within that asset and you kind of dissect all of it. You take the tile on the floors, the furniture in the building. If it's an apartment complex, you're taking the shingles on the roof, you're taking the windows, you're taking everything but the structure itself, and you're depreciating that. And what's cool about cost segregation is that there's different tax laws, right, where you could take so much depreciation on assets at a given time. So our normal depreciation is 27 years, over the course of 27 years that you can depreciate real property. But personal assets, you could depreciate them in 5 years. So you could take a $10 million building, let's take for example, okay? So we'll talk about this at a little bit larger scale. And you could dissect this and bring this down to real terms. So if you're buying like a $100,000 or $1 million building, same regards. You could buy like a $1 million building. In fact, let's talk about it more on like a $1 million building so that we can relate to the masses. Now I know there's some of you guys that are watching this going, no, Jerome, talk about the $10 million building. Just 10x this. Just go in and multiply this times 10 and it's exactly the same. We'll do $1 million building so that we can relate to the masses, and we can talk about how we depreciate that asset. So you take that asset and you say, okay, I paid $1 million for this building, and I have 8 units of real estate. I have 8 apartments in it, let's say, or I have 8 warehouse. I have a facility with 8 leases or in 8 individual units of real estate. Okay, so for sake of example, you take a building, whether it's 8 multifamily units. Okay, so you go 1, 2, 3, 4, 5, 6. So it's 1, 2, 3, 4, 5, 6, 7, 8 units. Okay, so you got 8 units. $1 million. Okay, and you take this $1 million. There's 8 units here, and you take these 8 units, and you say, okay, here's the structure. Now within this structure, there's flooring, there's tile, there's these rails right here that you see. There's furniture in these. You know, there's heating units, there's cooling units, there's showers, there's sinks, there's bathtubs, there's all kinds of different materials that were used to build that, and that stuff can be considered what we call personal property. So when you hire a CPA or accounting or a tax segregation professional, here's how it works in relation to taxes. Because I love real estate, I'm not only going to talk about tax segregation today. What I'm going to talk about today is also how taxes benefit you through the means of real estate and through multiple ways. Because you could go in and you could take the value of this asset at $1 million. Now, with tax bonuses that were put together a few years back, we were able to take up to 100% of depreciation in the first year. Now we could take up to 80% of depreciation of the entire asset within the first year. But when we go in and we do a tax segregation study to be able to take the tax bonuses and take that 80% tax write-off, one thing that we look at is we say, okay, if we can only depreciate the entire asset over 27 years, but we can take the personal property that's in there over 5 years without tax bonuses, and we do a tax segregation study, what is that personal property? Well, how much is this floor tile worth? How much is this handrail worth? How much is the furniture in that building worth? How much is the desk that the leasing agent sits at? How much is that worth? How much is the shingles on the roof of this building worth? How much are the drapes, the curtains, and stuff like that are just amenities in there? How much is that stuff worth? How much is that swimming pool worth that's on that property? How about the statue and the signs that are part of that property that you can dissect out of that property? How much is that worth? And you take all of these materials, all these building materials that you use that you have on that property, and you say, okay, there is $500,000 of real property that I could depreciate over 5 years. So you sit back and go, okay, I want to take 20% of the entire depreciated value of $1 million. So you could take $200,000. Okay, so if you say I'm only going to take 20% of the whole asset, and you take 1 million, that's $200,000. Okay, now there's multiple ways to do that, right? You could take the entire depreciation of the entire asset and say, okay, I'm going to take $1 million, take 20% of the entire asset. Or if I can't do that because of the 27-year law and there's no tax bonuses, I'm going to take a tax segregation study, and I'm going to take all of the builder's building materials, and let's say that the building materials are worth $500,000, but you want to take 200,000 of that, only 20% of the full asset value in the first year. So even if the tax segregation study comes back and says, Jerome, you can dissect this entire property and take up to $400,000 or $500,000 in depreciation in that first year, I sit back and say, you know what? I don't need that because I only bought land and built 2 houses this year. And so I know that I took the money and invested $200,000 into this. And so the money that I made for my down payment to invest the $200,000 into this building to purchase it, let's say you did an 80% loan to value and you put 20% down, okay? You made $200,000, you built 2 houses. You made $200,000 building 2 houses, okay? That was your earnings. Now you have your W-2 paid income from maybe being a school teacher or being a firefighter or being a police officer or being an attorney, whatever it is. You're paying taxes on that stuff. So maybe you sit back and say, well, I want to take $300,000 of that because I made $100,000 in wages and I want to get my money back from my 9-to-5 job, but I also I don't want to pay taxes on this $200,000 that I made buying land and building houses. So I want to take a tax segregation study to see what it's worth. Now, the tax segregation, the CPA comes back and says, Jerome, based on the tax segregation study, we could take up to $500,000 in depreciation on this asset. And you say, you know, Mr. Taxman, I'm only going to take $200,000 because I don't want to pay taxes on the $200,000 that I generated from buying land and building houses. And so he says, so he goes, okay, Jerome, what do you want to do with the other $300,000 on this tax segregation study? I say, well, I'm going to build 3 houses next year and I'm going to probably make $300,000. So I'm going to reserve that $300,000 tax write-off for next year. And what's cool about real estate is that those tax write-offs, they never expire. So even if the next year the economy went bust and you still only built 1 or 2 and you only had a profitability of $150,000, well, the next year you could take $150,000, and then the year after that you could take $150,000 and pay 0 taxes in 3 years. Now I know some people are sitting back going, Jerome, that's not fair. We're paying income taxes. Why don't you pay income taxes? Don't worry, if you guys have ever seen my video where I have a stack of property taxes this big, we're paying millions of dollars in property taxes. We're paying our fair share of property taxes. You see our 941s for all the economic growth that we have for employees and people that we're feeding, not only here locally, but employees and staff that we have all over the country, and even people now out of the country that are working for us. We pay a plentiful amount of taxes. Their income taxes, property taxes, we're paying taxes all day, gross receipt taxes, millions of dollars worth of revenue on building and developing houses. All of that stuff gets paid in what we call sales taxes, gross receipt taxes. So we're paying millions upon millions upon millions of dollars. And what the federal government says is they say, we want to incentivize the people that are actually stimulating the economy. So for those of you guys that sit back and say, Jerome, this just isn't fair. It's not fair that you don't have to pay income taxes when the rest of us go to work and pay income taxes. Well, ladies and gentlemen, let me tell you something. Our federal government will incentivize you to go out and stimulate the economy. And this is how they do it. They want to reward the people that are stimulating the economy, creating jobs, creating workforce, creating housing for people. They want the economy stimulated because our federal government, they can't build out this infrastructure of development themselves. So they say, look, investors, if you take the risk, you put out the capital, we'll give you the tax benefits of being able to write this stuff off as an incentive for doing so. And so we pay our fair share because when we're building this asset, we're paying we're buying millions of dollars worth of materials, and we're going to pay thousands of dollars worth of gross receipt taxes, sales taxes. And not only that, we're going to pay property taxes on this asset from here to the end of time. Okay, so they're going to generate revenue on this, federal revenue, local revenue, state revenue on this asset forever. But they're going to say, hey, put this together. We'll give you an income tax write-off that won't expire. And so, ladies and gentlemen, one of the number one best things about real estate that I love more so than anything is the tax benefits of it. You can go out, and in early years, I used to sit back and say, you know, I'm going to go out and I'm going to generate, I want to make millions and millions of dollars. And rightfully so. I think everybody that's watching this video should. They should create a business and a business model where they can go out and make millions upon millions of dollars. Then, when you make that millions and millions of dollars, and after you pay 40% of it back to the IRS, and you sit back and go, damn, I made millions of dollars and I paid 40% of all that hard work, hard effort back to the IRS, you're going to sit back and a little light bulb is going to go off and say, I remember that video that Jerome put together talking about tax segregation and writing off real estate. I need to get on that. I need to jump on that bandwagon and on that train so I can be able to take advantage of this stuff. Because here's the deal. You go back in, you get this building, it's worth $1 million. You go in, you do a little value add to it. Let's say that you put in $10,000 per unit. You have 80 of them, right? You put 80,000 modest dollars into this building right here. So now you're $1,080,000 into this building, okay? But you also get a write-off that $80,000. So you have, so you're 1.8, not 1.8, 1.08 into this building. Now, that value add just increased these rents by, let's say, 10%, okay? So if they were paying $1,000 a month, each one of these tenants, now they're paying $1,100 a month. And just from that income bump, this property now is worth $1.2 million, okay? Value. So you could do your renovations, you could do your tax segregation, and you could take this write-off in here. Now, here's what's cool. You only owe on this building, it's worth 1.2 million, but you only owe 800,000 on it, okay? So you owe $800,000 owed. You can go back in and do what's called a cash out refinance on this deal. Get my calculator. You could do what's called a cash out refinance, okay? You do what's called a cash out refinance on this deal, and let's say you could do an 80% loan to value, non-recourse loan, and you go to the bank and you say, hey, Mr. Banker, I did some renovations, I increased the rents, it's been a year since I financed this property, I want to get some cash out of it, the property based on current value, let's get an appraisal, but I believe it's worth $1.2 million. Then you find out, you go back and you find out that rents have increased by over 18% this year, right? Because that's what's happening. And so you sit back and you go, okay, if rents have increased by 18%, I did a rent push of 10% based on the value add, not based on rent pushes, but just on the value add. So you sit back and you take your rent pushes of $1,100 times 8, right? That's $8,800 a month in rental income, okay? So you have $8,800 a month. Okay, and you're gonna multiply that times, what do we say, 12% increase times 0.12%, okay? So that just went up by $1,056, okay? So we'll call it $1,050. So plus 8,800. So now your monthly revenue is 98 times 12. So now your annual revenue just went up to $118,000, okay? So you're doing $118,000 per year in gross income potential, okay? The banker sits back and goes, Jerome, I know you thought that your property was only worth 1.2 million, and it's only been a year, you put some money into this, rents went up, and now that asset class, you land up going back and saying, you know what, Mr. Banker, hold tight for a minute. Let me do a rent push, let me come back to you in 6 months. This thing is cash flowing for me. I already have my tax segregation study done. I have $500,000 in write-offs based on my first tax segregation study. I'm gonna go back and give me a little time to increase these rents. You go back, you increase these rents, 6 months later, you go back to your banker, rents are up, stabilized, 6 months later, he says, you know what, Jerome, let's start working on this refinance. Your building is now worth $1.35 million, okay? So you go back in and you say, my building's now worth $1.35 million. Now, remember, you're only $800,000 owed on that property. So you take that $1,350,000. It's probably worth more than that, probably closer to 1.4 million by this point in time. And add another zero there, times 0.80. You have the ability to pull out $1,080,000, right? But you still owe $800,000. You may have paid this down a little bit. It's probably still, it's only been a year or two, so it's still probably like $790,000 that you still owe on that thing, right? So let's take out $800,000. So minus $800,000. You could pull out $280,000 on the cash out refinance. Okay, so you refinance it 80% loan to value. Okay, you go in 80% loan to value, no recourse loan. Meaning, what a no recourse loan is a loan that doesn't have any recourse on it. So if you default on this property, the bank just takes the property and it dusts you off and you walk. Now you don't want that to happen because you want to have this asset long term, right? Like you want this to be a generational wealth. You want this to be something you can pass on to your kids. So now you take $280,000 out of that property, this one right here. Guess what you do with that $280,000? You go and buy another property just like this. And you know what's cool? Is you have no money of your own personal money into that $280,000. And that $280,000 that you pulled out on a cash out refinance, guess how much taxes you pay on that? A big fat zero. Because it's not income, it's a loan. The bank lent you money that you're paying interest on that property. So now you have $280,000 that's a loan, not income, and it's tax free. Now just multiply that times 10, and that's $2.8 million if you're doing a $10 million asset. And so if you multiply this $1 million asset by 10, you do a $10 million asset, what I was saying before, that's $2.5 million on a cash out refinance that you pay zero taxes on because it's a loan that you could take back out and utilize to go buy more real estate and do this all over again. And then you could take that exact same piece of real estate that you'd use the bank's money on to purchase, and you can go out and take another $500,000 write-off in the first couple of years. Now, essentially, you have $1 million tax write-off over the course of time. You could do a tax segregation study or exercise your tax bonuses and take 80% of that, up to 80% of that in your very first year. Or you could write it out over 4 years, 5 years, 10 years, 15 years if you want to. Whatever it takes you to exhaust those tax write-offs. And for the next, whatever it is, the next several years, guess what? You pay no taxes. And so, ladies and gentlemen, one of the best values in the best asset classes is multi-unit real estate. Because you could go in, do tax segregation studies, you can take these tax write-offs, and you're benefiting two ways. You benefit from the tax segregation study and the depreciated value of this asset, or the personal items within this asset. And some people are sitting back going, Jerome, but tile isn't really a personal, it really isn't a personal item. That's not the way that's not the way the IRS looks at it. The IRS sits back and goes, this is a piece, this is detachable, it was added to the building, this paint was added to the building, this molding was added to the building, this handrail was added to the building. Good morning, Precious. That stuff was all added to the property. It's personal property. We'll take a tax segregation study, we'll depreciate that stuff out, we'll take the tax write-off, and essentially, over the course of time, I have a $1 million tax write-off. I have $280,000 that I get tax-free, and I get to go buy more of these, get another $1 million in tax write-offs, and in a year or two down the road, I have another $280,000. And ladies and gentlemen, You guys want to understand compounding interest? You guys want to understand why my logo is compound your success? It's because when you do this, the compound effect, it's the compound effect of all of this that really makes the real estate game exciting. So when people sit back and go, where did Jerome get compound your success from? It's from the compounding effect of real estate. Real estate is my game. Real estate is my love. Real estate is one of the best asset class, is one of the best industries that you can be in to create wealth, but not only create wealth, to protect your wealth. And if you understand the game, you understand how to do it right, it's one of the best ways to evolve and compound money in the world. And so when you look at this stuff, you can't do this in the stock market. You can't depreciate your stocks. You can't go back out and do a tax segregation study on the stock market. You can't do that stuff. But in real estate, real property, you can. And so you can benefit from all of these tax strategies by one stupid, simple, little piece of real estate. And so while you go out there, you generate revenue and you go out and make millions of dollars, like everybody wants to make millions and millions of dollars, ladies and gentlemen, you're going to pay millions and millions of dollars in taxes and give it back to the IRS. Unless you learn this game right here. Because you can go out, buy land, build houses, and make a whole ton of money and make millions and millions of dollars doing it. But there's nothing worse than working so hard to make so much money and then giving it back to the government in taxes. So why not go in, stimulate the economy, get incentivized to do it, go out and buy real property, get cash flow from this property for the rest of your life. Pull money out, and that's what you call good debt. And then utilize that to compound your money, compound your success, and compound your life. And ladies and gentlemen, that's how you go out and you create wealth through the means of real estate.